You've called it the great head fake, the great inflation head fake of the next couple of months. Can you walk us through it?
Well, the inflation rate, because of a decline in prices that was seen last year after COVID hit, that decline will be met by a year-over-year gain. We think in the consumer price index, the CPI, not the PCE that the Fed targets, of 2.2% or so, up from the mid ones that we've seen of late. But then we see it by year end moving down back to 1.7% or so. It'll climb, we think, by the end of 2022 to 2.2. Now, the significance of that in terms of Fed policy is that a 2.2% CPI at the end of next year probably means a PCE, personal consumption expenditures deflator, of something less than 2%. Now, the Fed has said it won't raise its policy rate until the inflation rate has been at 2% for about a year and shows signs of accelerating to above 2% for some time. And so the market now, looking at Eurodollar futures for December 22, they're priced today for the Fed to raise its policy rate by a full quarter point by the end of next year. So we would say that it's highly improbable and that more likely the first rate hike occurs somewhere in the end of 2023. So there's some value to be harvested in the front end of the yield curve for the bet that the market is making on the Fed moving early.